Hello friends, thanks for watching this video. I work on daily basis with lot of trader and people keep on asking me what are the key elements required for being a successful trader. They keep on asking, how they can be a consistent profit taker from markets, how they can generate a good income from market by trading. It could be intraday trading or swing or positional trading basically. I have also observed that a lot of people keep on chasing for 100%, 80%, 90% accuracy. They keep on looking for holy grail of trading. That doesn't happen. Trading basically means a simple arithmetic. If you can do it arithmetically right, you could be even a successful trader with 20% of accuracy. Yes, my dear friends, you can be a successful trader with 20% accuracy provided you do certain things right in trading. And that is how professional trader do it. So let's discuss the key element of successful trading here. Here is small screenshot of my profile. So if you want to look at this, you can just pause and see what are the things I have done. Otherwise, we can move to next section. So for being a successful trader, there are three things. There are three pillars of for successful trading. One is strategy. Second is risk management, and third is your risk reward. Okay. So when I talk about strategy means like the system of entry and exit into a trade. The condition that you see for entering a trade or exiting out of a trade. So it could be a simple moving average crossover. It could be your open high low close. It could be a breakout or it could be anything basically. It depends upon individual trader choice, what you want to trade, what is a system of entry and exit from a trade. Second is like risk management. When I say risk management is like how much capital you are putting into one single trade. Okay, like I do 1% capital into one trade so that I can have 100 wrong trade before I completely blown out of my money. Some people do 2% of capital, but generally it is recommended we should not have more than 2% of capital into one single trade. Okay, last is risk to reward ratio. Risk to reward ratio means the reward you are getting for 1 rupee or $1 you are investing into that particular trade. So let's say that if I put 1 rupees and I am expecting 2, so my risk to reward ratio would be 1 is to 2. My you know let's say if ratio is 1 is to 3, it means my I'm putting 1 rupee or 1 USD dollar for earning 3 out of that. Okay, it could be 1 is to 4, 1 is to 5, depending upon the kind of system that you trade, and basically it comes with the experience. Whenever you trade, you decide at the beginning, before you taking trade, you decide that this is gonna be risk reward, this is I'm expecting that this trade could go to this level. Okay, so you calculate risk to reward basis on basis of that. Okay, so that's a risk reward. So these three things, strategy, risk management and risk reward, combining together, okay, they work as a basically base for successful trading. Now next comes your quantity calculation. Now we know our risk, we know that our trade is meeting risk to reward ratio criteria also. Okay, so next step comes is quantity calculation. So we calculate quantity based on a risk like I said, I take 1% of my capital, okay, and I divide that by the difference of price and stop loss for buying trade, and by the difference of stop loss minus price for selling trade, because for selling trade price is lesser than the stop loss. Now I calculate quantity for my trades, buying and selling. 1% of capital divided by the difference of price and stop loss. Since I know the quantity calculation also, so let's jump to some real life examples. Here is my first example. I have changed the name of company, but these are real life example that I have taken. So I'm taking XYZ buy trade. Okay, my current market price is 250. My stop loss is 247, and my target based on my risk to reward is, and based on my entry system on strategy, I predict that that this can go to 256. Okay, so basically 6 point of reward and 3 point risk. So it is meeting my criteria. Risk to reward is 1.2. Based on a formula of quantity calculation, I'm also calculating the quantity here. Okay, so quantity comes out to be 1666 for this particular trade. This is a buy trade, and I'm gonna take this. The second example is of ABC company. The current market price is 650, stop loss is 645, and the target is 660. Okay, so risk to reward here is 5 point. Risk is 5 point and reward is 10 points. So basically my risk to reward ratio comes out to be 1 is to 2. My capital is of 5 lakh, and essentially, based on formula, I calculate that I will be taking 1000 shares in this particular trade. Okay, so this is my second example. My third example is of DEF company, again a buy trade. Okay, current market price is 1260, stop loss is of 1256, 4 point risk, target is 1276, so my rewards comes out to be 16 points. So my in this trade my risk to reward ratio is higher, the highest in all three trades. It is 1 is to 4. Again I'm calculating quantity, so it comes out to be 1250 shares basically. Okay, so all trades, three trades I take, because it is meeting my risk to reward ratio. Now combining this together, all three trades, putting into one sheet, so this is how it looks, all three trades basically. Okay, now there are 4 or 5 scenarios which are possible. One, all three trades go wrong, I will be losing 15,000 bucks. That's a worst case scenario for me. Scenario second, my any of first two trade work and rest two are not working for me. In that case, I will be losing two trades, so 10,000 bucks gone, and my profit would be of 10,000. So net sum is 0. That's the power of 1 is to 2 risk to reward ratio. Okay. The third is, I win first two trade and third one doesn't go well. Okay, in that case I will be earning 20,000 bucks and I will be losing 5,000. So my net profit is again 5,000, sorry, 15,000 here. Scenario 4 is that my third trade work and first two are not working for me. Since this is 1 is to 4, I would be earning 17,500 bucks as a profit, and I will be losing 10,000 for first two trades. Okay, so my net profit would be 7,500. Okay, even if I lose one more trade here, I will go to 25% of accuracy. Okay, even in that scenario, at 25% accuracy, I will be profitable in scenario number 4. That's the power of high risk to reward ratio trades, and it just, you know, give you leverage to lose more. So what is needed for successful trading? One, your system should offer you trade which are having a higher risk to reward ratio. As we discussed earlier, higher risk to reward ratio means that you have more leverage to accommodate losing trades. Even with the lowest of accuracy, you could be a successful trader if you trade high risk to reward ratio. With 1 is to 2, you are profitable with 50% accuracy. Okay, if your risk to reward ratio is 1 is to 2, no, sorry, 1 is to 5, you are profitable with 20% accuracy. So that's the power of basically, managing this math right. Second point that I want to talk is like, you should not trade too heavily quantity wise. You should not trade too low quantity basically. The reason for that is whenever a wrong trade goes, okay, uh, trade can go wrong. Okay, so whenever that happen, you should be able to jump to next trade without thinking that I have lost money, my trade is not working. Okay, so trade quantity that doesn't break you emotionally. Okay, trading is all about mathematics. If you could manage your risk reward, your risk management properly, anyone can be profitable. And it's like, doing it mathematically and emotionally right. That's it. Thank you.